So it's an asset that it's not just performing in doom and gloom periods, right? It's performing in down markets and up markets, even though sometimes it's like watching grass grow.
It's not for the white knuckle guys who want to trade, buy and sell every day.
Yeah, like listen, there's better ways to get rich quick. It's definitely not a get rich quick scheme. But if you want something that's stable, that is going to consistently return you decent percentages, and something that you can hold either yourself or in a facility that's outside the financial system, it's the number one asset to hold.
It's a really effective way to store value. In the last, what, 80, 90 years, with the US dollar being the reserve currency, that's where most of the world has kind of stored value. When they need to kind of protect against their own national economies or whatnot, they buy US dollars and they buy US bonds. It feels like there's a shift right now where there's a little less trust in the long-term value of the US dollar.
One thing that's become apparent, and this is over the last two administrations, is countries specifically are holding much less in terms of treasury bills and US debt. And so ultimately what that does is our dollar loses value, but also they're flocking to other instruments to be able to store their own value in terms of their country reserves. And so a statistic for you right now, in 2024, 25% of all gold was purchased by the Chinese central bank. That was not the case 5 and 10 years ago, right? We have to remember gold is being purchased by central banks at record levels right now. And the reason is if we go back and look historically at this, right? In 71, Nixon ended Bretton Woods, which was not the gold standard. That's what Roosevelt ended. It was a gold exchange system, right? Since then, the US dollar was set as reserve currency because of the petrodollar, right? Countries were paying for oil in US dollars. Well, that's not happening anymore, right? China is paying for oil in yuan, and they also actually are paying for oil in gold at times. You have Russia, who's buying both gold and silver, and they're trading that and rubles for oil. And so really what it's done is it's destabilized certain safety instruments to investing, right? A great example of how this has changed the landscape is, for the last 25 years, a lot of the banks, Bank of America primarily, has suggested a 60-40 portfolio, right? 60% of your money in stocks, 40% in bonds. If you were to go on Google right now and Google it, Bank of America and several other banks have been coming out since November and said that 40% should not be in bonds anymore. It should, in fact, be in commodities. Not gold specifically, right? You can smatter that 40% between gold, silver, other physical commodities too. And the reason is because they're outperforming bonds, right? We're in a similar situation when you look at I know inflation numbers are coming down, but if you look at what happened through the 70s, right, we're in a kind of strange situation like that. Not necessarily stagflation at this point yet, but really what the Fed's done is they've handcuffed investors. And that's because we have tariffs right now. And so they're not willing to cut interest rates to bail out the stock market and these other paper investments because the uncertainty caused by tariffs. But then at the same token, these elevated interest rates are causing a lot of investors a lot of harm when it comes to the fact that they're paying higher yields on everything, right? Like the institutions are leveraged everywhere. They're using leverage. So leverage is much more expensive. And the concern becomes, well, hey, we know the Fed has come out and said they're going to be cutting rates. They've delayed it till September because of the tariffs. We know if Trump had it his way, interest rates would be at zero today. And so the concern then becomes, okay, if rates are falling, yields follow. So your bonds aren't going to be performing. And the other thing we know is if rates are falling, the yield on the dollar is falling as well. So the value of the dollar is falling, so to speak. And so this means bonds aren't a great investment over at least the next 3 years. Whereas, for precious metals, the sky is the limit in terms of a low rate environment. If we look at how gold and silver have done during interest rate cutting cycles since 2000, there have been 3 to 4 major interest rate cutting cycles. The average return in silver during an interest rate cut cycle is actually 413%. The average return in gold, it's not as much, but it's 245%. And so, again, this isn't saying, sell the farm and sell all your stocks and go into metals, because that's not good for anybody. But it's definitely a fantastic move for a specific percentage of your portfolio.
Yeah, I'm glad you mentioned that what we're not saying is go all in on gold, right? I mean, it would be easy for you, given your business, to tell people to do that. Give us the reason why we're not going all in on gold, or why it wouldn't be wise, or what are the risks that we have to consider when you're buying commodities specifically?
So I think, I'm going to cite that CPM Group study again, because they actually had a risk versus reward curve in their study. And it's not saying that you won't make more of a return on average if you have more gold in your portfolio. What it is saying, though, traditionally riskier investments, stocks, even stuff, real estate, for instance, which we know can be subject to yields. Those investments that are riskier tend to have short-term payoffs for taking that risk. And so, if you had 75% of your portfolio in gold, over a 50-year period, you would have made a bigger return than if you had all of your money in the S&P 500, according to that study. But where you would have lost out is the potential chances, for instance, on an IPO, or for instance, on a tech stock, where you can double your money in a year, right? And that's not saying that happens every day, but it's one of those things where you can earn higher returns in certain riskier investments. Look at Nvidia, right? I know Nvidia is down right now with everything going on in the tariffs, but you could have made 10,000% in like 6 or 7 years, right? And so that's not something that happened in gold. I think the other thing to keep in mind too, especially as we get close at or near retirement age, 100% of your money in anything is dangerous, because you're starting to need to take money out of what you've contributed for all these years. And so if you have all your money in a single asset class, if that asset class has a short-term correction and you need funds, you're really getting hammered, right? And so that's where the diversification comes into play, right? There used to be the permanent portfolio, where it was 25% in stocks, 25% in bonds, 25% in commodities, 25% in cash, or an asset that's like cash. And so if you look at that, the reason they were suggesting that is, well, let's say we have a stock market correction. You have 3 other asset classes you can pull funds from that aren't losing money, and wait for it to come back.
Absolutely. Well, great. Thank you very much. Appreciate having you on.
Awesome. Thanks, Jonathan.